Macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen. Is this end of the quarter just the beginning of a market correction? Our market timer, Kevin Cook, will have the answer to that question. He's here with me right now.
I hope so.
So, well, we're counting on it. Where do you stand on this? Buying opportunity now?
Yeah, very interesting week here where S&P tries again for a new high. We actually got a close above 1560, which was bullish to me. And we've got a reversal on our hands this morning.
Yeah.
So
and this morning's the 27th.
Right. So a little bit of selling. We're at sort of an inflection point here for a lot of the indexes where some of them have run really hard. And what we're going to do today is I'm going to look at all the indexes but use their tracking ETFs, because what the tracking ETFs show you are two things you can't see in just a regular index chart. You get to see the gaps open higher and lower, and you get to see the volume. So, and my approach is to stay with the trend. So I always look at possible scenarios, and then I kind of weight those scenarios with probabilities. And as I identified to my group this week, I said I see about a 1 in 3, 35% chance of the S&P trading in a range below 1560 down to 1520. So here I've got it marked on the spiders, 152 up to 156. I still believe that's a likely scenario. I had a 35% chance of rallying to new highs above 1565. That's getting taken behind the woodshed this morning as they sell it. And on here I've got, so this is a 3-month daily chart. I've got 10, 20, 50, and 100-week moving averages. Now, moving averages are just trend markers, but they do tend to provide some support and resistance as long as there's a confluence of other factors. So what I've got drawn here is at 152 on the spiders, which is near the top of that congestion we had in February, also coincides with the 50-day moving average. So that's why 152, 153, 1520, 1530 on the S&P should be good support for any pullback we get. Let's go to an index that has run quite far and is looking a little weaker, and that's the Russell 2000. Here I'm looking at the IWM, and what you see is you see the red volume there, some definite distribution days, but still holding the lows from mid-month around 993 in the IWM, about 930 in the Russell 2000. So what we want to see there is and we're sitting right on that 20-day moving average. We'd like to see it hold there. Obviously, if it breaks that, then a trip down to the congestion zone in February at 9150, which is 915 on the Russell, coincides with the 50-day moving average. So I'm staying with the long trend, but would certainly welcome, a 3% pullback here. It could be greater since we're end of quarter and we're going into April, and everybody's worried about what's happened every April and May for the last few years.
Yeah. Well, from these two charts, is it a fair assumption that the big caps are still in favor?
Definitely, and money is just going to rotate. Money has been piling into bonds, which is a little bit of a caution sign. The Treasury yield, slipped back. The 10-year slipped back below 2%. You see an ETF like the TLT rallying, so that's been some caution here for a couple of weeks. But equity money is just going to rotate to safer equities, stay with the big caps. And the Russell, you look again, this thing has run so far, to all-time highs here, above 870, all the way up to 950. So room to take profits there. Let's look at the other big cap index, which makes the headline, and that's the Dow. DIA here, the ticker for the ETF. This one looks like one of the strongest indexes. And so still trending strong. And until the Dow breaks say 14,350, I'm not worried about the Dow at all. So it's just something we have to keep an eye on. Although I did read something interesting from William O'Neill, Investors Business Daily, something he's been watching for 30 years probably, that often what happens at a top, and he cited the 1984 peak in the Dow, that the Dow gets pushed up because larger institutional players can push up the big stocks fairly easily. That makes the headlines. Meanwhile, they're selling, the other 400 to 2,000 stocks around the globe. Let me show you the mid caps, another index that's been incredibly strong. Now, this is the MDY. The funny thing about the MDY is it doesn't correlate exactly to the mid cap 400 index in terms of like a ratio. On the spiders, it's 1/10, right, of the S&P. The diamonds, it's 1/100th. IWM is 1/10. So those are like clean ratios when you try and figure out how the tracking ETF corresponds to the index. The mid cap, I'm not exactly sure about, but this is a 2-year weekly chart, by the way, and I just left the moving averages on there. What I want to point out is that 185 level on MDY corresponds to the big breakout to new highs on the mid cap above 1,020. Now, where could we pull back to? We could certainly pull back to the February lows this year of 195 on the MDY, which corresponds to about 1080 on the mid cap, and and that would still be a very mild pullback. You don't even get to a 10% correction coming all the way back to the big breakout level at 185 or 1020 on the mid cap. So, the indexes are going to be jostling around here, and we expect to see that. Some institutions are net sellers. They want out of this market. Others are still looking for new highs.
Well, that leaves us with the NASDAQ.
Yeah.
Are we ever going to see that tech bubble again from the 2000s?
Yeah, I don't think the NASDAQ's going back to 5,000 anytime soon. But let's look at the QQQs, which is the tracking index. And I just want to focus, again, this is a 2-year chart of the triple Qs. We've got a head and shoulders formation here that everybody's watching. Now, that 69 on the right shoulder corresponds to about 2,800 on the NDX, which is the full NASDAQ 100 index, which the triple Qs track. So, and we've just been sitting there trying, is it going to break above it, or is this the place to crash and get short? And there's a lot of money betting both ways here. I still like the trend higher in the triple Qs. I thought we could break above that. And if we get a solid close above 2,800 on the NDX or 69 on the triple Qs, then we're off to the races for what I think could be another 10% rally. Pullbacks, I think, will be bought to 66, which is where the 20 and 50 week moving averages coincide that you can see on here. And one thing I want to back up to on the mid caps is if you look down in that lower right corner, you see the declining volume on the mid cap. Now, this is on a weekly basis. We had a big distribution week in mid-February, and then it's been declining volume on this rally. So mid caps and small caps are the most vulnerable for a pullback. And if the triple Qs fail at this right shoulder and it does become a head and shoulder top, then the Qs are going to go much lower too. Could be 400 points on the NASDAQ 100 down to 2,400.
All right, Kevin Cook. He's our market timer here at Zacks. You can follow him on our website, Zacks.com. You can follow him on Twitter and StockTwits as well at Kevin B. Cook. With Kevin, I'm Terry Ruffalo.